Not even Donald Trump is safe from Wall Street, a place of high finance, big dreams, and even bigger scams. One of those scams? Naked short selling. Imagine borrowing something you never intend to return, then selling it to tank its price. That's naked short selling. It's often used to manipulate the market and crush companies. Legal? Debatable. Moral? Definitely not. And no one is safe. This is a tactic used by powerful people known as smart money to make a quick buck at the expense of everyone else, and not even presidents are safe. They manipulate stock prices, spread misinformation, and leave a trail of shattered companies and ruined investors in their wake. They often get away with it. Naked short selling is different from regular short selling. In regular short selling, you borrow shares from someone else, sell the borrowed shares, and hope to buy them back at a lower price to return them, pocketing the difference. But in naked short selling, the seller doesn't even borrow the shares. They sell the shares they don't own and haven't borrowed, creating a situation where the shares might not even exist. This can lead to an artificial increase in the supply of shares, driving the price down. This practice can be particularly damaging to smaller companies which don't have the resources to withstand such an attack. When their stock prices plummet, it can lead to a loss of investor confidence, making it harder for these companies to raise capital and continue operations. The ripple effect can be devastating, not just for the company, but for its employees, customers, and the broader economy. Regulatory bodies like the SEC have rules in place to curb naked short selling, but enforcement often lacking altogether. Many institutional traders can still exploit this tactic. There have been fines and slaps on the wrist, but that's about it. The practice runs rampant. The next time you hear about a stock plummeting out of nowhere, remember it might not be investors selling stock. It could be the result of naked short selling and market manipulation. Let's talk about DJT, the stock for Trump media. It's been on a wild ride recently with sharp drops and sudden surges. Coincidence? Maybe. Or maybe it's another case of Wall Street shenanigans. Some say DJT is being targeted by naked short sellers. They point to unusual trading activity, negative media coverage, and a general sense that someone is trying to push the stock price down. And you know what? They might be right. Remember ABC News? They ran a story about DJT, painting a very negative and bleak picture of the company's future. They talked about declining stock prices, weak earnings reports, and a general lack of investor confidence. Their propaganda was really clear. DJT was in trouble. The report highlighted the plummeting stock prices, showing a series of red arrows pointing downwards. Traders on the floor looked stressed, their faces a mix of worry and frustration. Financial analysts were seen poring over reports, shaking their heads in dismay, and investors were shown in heated discussions clearly anxious about their investments. But here's the thing. They conveniently left out some crucial information, important details that could change the entire narrative. For instance, they failed to mention Trump's recent vow to hold on to his shares, a move that usually signals long-term confidence in a company. This kind of commitment from a major shareholder can often reassure other investors, and Trump definitely reassured investors.
Shares are down about 75% from their peak in March. Your lockdown provision ends soon. Will you sell your shares?
No, I'm not selling. No, I love it. I mean, I use it as a method of getting out my word. When it opened, it went way high, but then the SEC gave us nothing but problems. We had to go through a long process with the SEC. But people think that I'm leaving. That's why they're down, because if I leave, it's different if I leave. But I'm not leaving. I love it. I think it's great. Mechanically, it works the best. And again, I'm friendly with Elon, and Elon would love me to come over to X, but I just, I have close to 100 million people on X. I had 230 million people on X, and then they shut me down, and I said, I'm not going to let that happen again. You know that. I had hundreds of millions of people on X and Facebook and Instagram, I think more than anybody. Zuckerberg told me at the White House, he said, congratulations, you're number one on Facebook. This is a number of years ago. And then all of a sudden, I went from being number one to having no voice. And after about 2 or 3 weeks, because I have a lot to say, I put out old-fashioned press statements, like a press statement. And they got really successful, and they did very well. And then we built this platform. And the reason I built it is because I don't want to have my voice shut down. But a lot of people think that I'll sell my shares. You know, they're worth billions of dollars, but I don't want to sell my shares. I'm not going to sell my shares. I don't need money. And it is for me, it's a great voice. It's a great voice. And it's a voice, it works so well. And we just won, as you know, we got final approval from the SEC. It took us a long time. And that really turned it off. You know, when I originally opened that stock, it went from about 2 to about 182. Did you know that? It was the biggest increase in the history of the stock market. I believe, you know, I have to say I believe, because you're going to find one company, maybe more, who knows. But I believe it was the single biggest movement. And I think I was worth $61 billion from that one stock. And then we had nothing but problems with the SEC. And it gets whittled down, down, down. But I didn't do it for the money. I did it because I really wanted to have a strong voice. And it's a great voice for me. And as long as my voice is on there, it's going to always be good. But a lot of people think the reason it's down is that a lot of people think I'm going to sell. And if I sell, it wouldn't be the same. I could understand that. But I have absolutely no intention of selling. Okay?
Share prices of DJT surged 25% and were halted by the NASDAQ, leaving investors furious. The mainstream media glossed over the surge in stock price that followed Trump's statement. The market reacted positively, with prices spiking almost immediately after his announcement. It's almost as if they were trying to paint a negative picture, regardless of the facts. The selective reporting raises questions about the intent behind the story. Were they trying to influence public perception, or was it simply an oversight? In today's media landscape, it's crucial to look at multiple sources and perspectives. One report might focus on the negatives, while another might highlight the positives. And the truth often lies somewhere in between. As consumers of news, we need to be vigilant, questioning the information presented to us. It's important to dig deeper, seek out the full story, rather than accepting a single narrative at face value. By doing so, we can form a more balanced and informed opinion. After all, in the world of finance and investing, knowledge is power, and understanding the complete picture can make the entire difference. So the next time you come across a story that seems one-sided, take a moment to consider what might be missing. The truth is often more complex than it appears at first glance. Stay informed, stay critical. Trump recently made a bold move. He publicly declared, "I'm not selling." Not now, not anytime soon. This wasn't just a casual comment, though. It was a clear message to the market. I believe in this company, and I'm not backing down. This kind of statement usually sends a stock soaring. It's a sign of confidence from the company's leader, a vote of support that can inspire investors to buy in. And guess what? That's exactly what happened. Initially. Then things got interesting. Right after Trump's announcement, something strange happened. NASDAQ, the stock exchange where DJT is traded, halted trading of their stock twice. The reason? Volatility. But here's the thing. Volatility is often a sign of manipulation. It's like stopping a football game because one team is scoring too many touchdowns. It makes no sense. Some people believe these halts were deliberate attempts to stifle DJT's growth and protect those who were shorting the stock. And you know what? They might be onto something. Investors are furious. They see these events as further proof that the market is rigged against them. They see powerful players manipulating the system for their own benefits, while ordinary investors are left holding the bag. They're tired of being taken advantage of, tired of the lies, the deceit, the lack of transparency, and they want a fair market where everyone plays by the same rules, and they're not going to stay silent anymore. Is this the new normal? Remember Gamestop and AMC? That was a massive wake-up call. Recently, Citron Research CEO Andrew Left has been charged with manipulation of stocks like GameStop, AMC, and Tesla, and he's facing 370 years in federal prison if convicted. The multiple short squeezes on GameStop and AMC have shown the world that ordinary retail investors, armed with nothing but intellect, social media, and a shared sense of outrage, can take on Wall Street and win. DJT situation seems eerily similar. It has all the hallmarks of market manipulation, the suspicious trading activity, the negative media coverage, the sudden halts in trading. It's enough to make you wonder, is this the new normal? The problem is simple: lack of transparency. We need to know Who's trading these stocks, how much they're trading, and whether they're playing by the rules. We need to shine a light on the dark corners of the market, where manipulation thrives in the shadows. By exposing these practices to the public, we can start to hold the perpetrators accountable and create a fairer market. This isn't just about DJT. It's about every company that's been targeted by naked short sellers. Even silver and gold derivatives are traded in dark pools by big banks and smart money at a rate of over 96% of the time. This greatly suppresses the real price of equities from stocks to precious metals. It's about every investor who's lost money because of market manipulation. It's about fighting for a fair and transparent market where everyone has a chance to succeed. We need stronger regulations, stricter enforcement, and a system that actually protects investors instead of rewarding the manipulators. And this is a fight we can't afford to lose. Fortunes can be made or lost in the blink of an eye. The future of DJT remains uncertain. New developments and market shifts create volatility and keep investors on their toes. But one thing is clear. This story is far from over. The ebb and flow of the market is a continuous narrative. It's a reminder that the market is a dangerous place full of sharks, predators, looking to take advantage of the unwary. The stakes are high and the risks are real. But it's also a call to action. We have to be proactive, not just reactive, in our approach to the financial markets as retail investors. We need to demand more from our regulators, better from our media, and our financial institutions. Transparency and accountability are crucial in maintaining the integrity of the market. We need to educate ourselves about market manipulation and hold these responsible accountable for their actions. Knowledge is power, and understanding the intricacies of the market can help us make informed decisions. The future of our financial system depends on it. Your financial system, your financial future depend on it. By working together, staying informed, and demanding accountability, we can help shape a more stable and fair market for everyone. This is our call to action, and the time to act is now. You can fight back by investing in a new stock and crypto brokerage being created for retail investors by retail investors. Lit Exchange will avoid the manipulation that occurs via payment for order flow and price-suppressing dark pools used by the vast majority of stock brokerage firms, market makers, and wholesalers.
We had to limit buying.
That markets are efficient because of active managers setting the prices of securities. Firms like Citadel, we're all running large teams of people that are engaged in fundamental research, trying to drive the value of companies towards where we think they should be valued.
Lit Exchange has launched a Regulation C crowdfunding campaign so you can own equity in the company. First buyer's rights of additional stock on IPO, and many other benefits that will never be available in the future. Fight fire with fire by becoming a founding member of Lit Exchange at the link below.
The synthetic shorting and naked shorting, which is illegal, market maker can execute naked shorts insofar as they're facilitating a trade. The regulators are looking at that now as to whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts, and I think they're going to uncover that there were some issues there. But the penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly.
In 2020, these brokerages collected almost $2.6 billion in payments for stock and option orders.
These brokers, including Interactive Brokers and Robinhood, that generate revenue from selling the order flow to market makers.
Business has always been done like this on Wall Street for over 100 years.
Our orders compete against each other to get the best prices. But if the order instead is routed to a wholesaler that has agreed to pay for it, the order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
As you mentioned about commission or zero commission does not mean it's free. It does have some cost inside.
United Kingdom, Canada, Australia, all have banned payment for orders.
As a result, Robinhood Securities imposed temporary trading restrictions on certain securities.
All these meme stocks have brought naked short selling really to the forefront of the market's interest. This is something that's going on for a very long time in the small cap market and is very much a problem.
The markets are efficient because of active managers setting the prices of securities.
The order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.